4 years ago, Alibaba hit an all-time high of $310 per share. But this Amazon of China dropped nearly 70% after COVID with the pullback in online shopping. While the stock has gone mostly sideways over the last couple of years, last week, Alibaba hit a 52-week high of 117.82, only to drop almost 14% since. Was last week's rise a sign of things to come? And should you consider loading up during this pullback? Tune in and find out. Shout out to FC for suggesting this week's company. All right, 3 points that we are going to cover in this video. Number one, background/business model. Known by many as the Amazon of China, Jack Ma's company has gone from an e-commerce focus to a conglomerate offering many different services. Part two, company updates and what the market is missing. Alibaba is making major moves in AI and it's expanding internationally. There's a lot to unpack in the company's 2Q24 results. I can't wait to share all the gold nuggets that I've uncovered. Now, while the stock is down, there are several points that the market might be missing, and I'm going to cover them all. Part three, valuation. On Wall Street, we build three-statement financial models culminating in a discounted cash flow or DCF valuation. I have built a three-statement model with a DCF, and I think that Alibaba has some solid upside potential, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. Okay, part one, company background/business model. Imagine a man sitting in his small apartment, tapping away on a computer, dreaming of building an empire that would one day compete with Amazon and reshape global e-commerce. That man was Jack Ma. And what started as a vision over 2 decades ago has become one of the largest companies in the world. But how did Alibaba go from a small idea in China to a global powerhouse? Founded by Jack Ma in 1999, Alibaba initially started as an e-commerce platform. Alibaba's rise from a small startup in Hangzhou to a conglomerate spanning e-commerce, cloud computing, logistics, and entertainment shows Alibaba's unique role in China's digital economy as the largest online retail platform. Some key milestones include their IPO in 2014, setting the global record for the largest IPO at the time. Also, the company is focused on strategic global expansion efforts and diversification into multiple sectors, such as cloud computing, digital payments, entertainment, and logistics. Next, we have the business model. So if you ever wondered how a company can make money from nearly everything that you touch online, from buying groceries to streaming a movie, Alibaba isn't just an e-commerce company. It's the digital backbone of millions of businesses, offering a sprawling ecosystem of services. But what's the secret to their business model?
What's in the box? What's in the box? What's in the box? Right?
So the core segments include e-commerce, which is Taobao, Tmall, AliExpress for consumer retail, and this covers e-commerce commissions and advertising on the revenue side. Also, they have Alibaba Cloud, which covers cloud computing and data intelligence. These are cloud services like B2B and B2C. Also, digital media and entertainment, for example, Youku Tudou, Alibaba Pictures. These are digital entertainment subscriptions and ads, as well as logistics via the Cainiao network. These are ancillary services like logistics, financial services like Alipay. So ultimately, Alibaba has an ecosystem strategy, how Alibaba connects buyers and sellers and third-party service providers to create a seamless online to offline commerce system. That is really the genius of this business model. All right, 2Q24 financial overview and insights. So revenue was $33.47 billion, a 4% increase year over year. Growth was driven by strong performance in cloud computing and international e-commerce despite headwinds in China's domestic retail market. Alibaba's diversification across segments helped maintain steady revenue growth despite a challenging macro environment. Income from operations was $4.95 billion, a 15% decrease year over year, primarily due to a one-time reversal of share-based compensation in 2023. So last year's reversal artificially inflated the prior year's numbers, making this decline appear larger than the core business performance would suggest. Now, while income dipped, it's more about accounting adjustments than operational struggles. Net income came in at $3.31 billion, a 27% decrease year over year, driven by lower income from operations and increased impairments of investments. The decline in net income was exacerbated by higher impairments on investments, reflecting tougher market conditions that Alibaba is navigating. Impairments are write-downs on the carrying value of investments. Now, the non-core investment losses have impacted the bottom line, highlighting the challenges in managing a broad portfolio. Free cash flow is 2.39 billion US dollars, a 56% decrease year over year due to higher cloud infrastructure investments and working capital changes. The significant drop in free cash flow reflects Alibaba's strategic investments in future growth, particularly in its cloud infrastructure and international expansion. Now, while cash flow is down, Alibaba is positioning itself for long-term gains in high-growth areas like cloud and AI. So what may the market be missing about the company? Long-term growth in AI and cloud. So the market seems fixated on Alibaba's short-term challenges, such as regulatory pressure and declining consumer spending in China. Now, what the market might be missing is that Alibaba's aggressive investments in AI and cloud technology could be a game changer in the long run. Their cloud business, with AI product-related revenue, is growing at triple digits and positions them as a key player in the future of digital infrastructure, not just in China, but globally.
Everything here was made in China, Pam.
This AI-driven transformation could lead to Alibaba becoming a dominant force in multiple high-margin industries beyond e-commerce. Undervalued international expansion. So the market's focus is on Alibaba's China-centric operations, which often dominate the headlines. It also skews market sentiment towards China's economic slowdown. Now, what the market might be missing is that Alibaba's international commerce segment grew 32% year over year in 2Q24, far outpacing its domestic growth, with platforms like AliExpress and Lazada gaining traction in Europe, Southeast Asia, and the Gulf region. Alibaba is quietly building a formidable international presence. This diversification could insulate the company from Chinese economic volatility over time. Strategic focus on operational efficiency. So the market's focus is on declining profits and income, which are overshadowing Alibaba's operational shifts. So what the market might be missing is that Alibaba's deliberate strategy to scale back loss-making ventures and focus on core operations is actually starting to yield some benefits. For example, their local services group significantly narrowed its losses, and Cloud Intelligence's EBITDA surged by 155% in 2Q24. These efficiency improvements could make the company leaner and more profitable in the long run, even amid challenging external conditions. Share repurchases show confidence. So the market's focus is that Alibaba's stock price has been volatile, reflecting investors' concerns about regulatory scrutiny and geopolitical risks. What they might be missing is that Alibaba has been aggressively buying back shares to the tune of 5.8 billion US dollars in 2Q24 alone. This signals strong internal confidence in the company's future. Now, management believes the stock is undervalued, and I tend to agree with them. This could be a key indicator that the current market price doesn't reflect Alibaba's true intrinsic value, particularly over a long-term time horizon. Resiliency amid regulatory uncertainty. So the market's focus is that they're concerned about China's regulatory environment and its impact on large tech firms like Alibaba. But what the market might be missing is that despite heightened regulatory oversight, Alibaba has demonstrated the ability to adapt and thrive. Regulatory concerns have already been largely priced into the stock, and Alibaba's ongoing investment in areas like AI, cloud, and international markets show that the company is looking beyond these hurdles. The company's focus on data privacy, compliance, and collaboration with authorities positions it well to navigate the regulatory landscape. All right, next, the moment we've all been waiting for, the valuation. So we're going to start with the balance sheet. Cash and short-term investments have seen a 2.5x increase over the last 5 years. As mentioned earlier, the company has made many significant strategic investments, which can be seen in the 34% increase in equity investments from 2019 to 2023. Debt has remained relatively flat since 2020 as the company has remained focused on financing the business through retained earnings. Retained earnings is up since 2019, but down since 2020. The company began paying a dividend to shareholders in 2023, and retained earnings is projected to increase 12% year over year in the projections. We're going to see this next in the income statement. So what's the takeaway? While the company hit a rough patch after 2020, cash is solid, equity investments are growing in value, and debt is under control. Let's hop in the model. All right, balance sheet, as we mentioned, big increase in cash and short-term investments over the last 5 years. Equity investments have also increased significantly as well. Debt has actually remained pretty much under control, which is a very positive sign. Retained earnings has seen a nice increase. Overall, I would say that the company has a pretty solid balance sheet and everything is turning in the right direction. Next, we have the income statement. There's a lot to unpack here. Top line revenue growth has increased 2.3x over the last 5 years, but that's not the whole story because net income over the same time frame is down 17%. Now, 2020 was an obvious inflection point for the company, and while gross operating and net margins are down, EBITDA margin is actually up. Since 2020, the increase in SG&A, selling general administrative, so basically think of sales and marketing expenses as well as overhead paying employees, is only 4.3% higher because they've controlled their hiring and marketing spend. More importantly, product development costs are down 17.2%. This combination has resulted in a 21.5% increase in EBITDA and slight EBITDA margin expansion as well. Now, they had $5.8 billion of impairments over the last 3 years, and that's negatively impacted the company. And these are due to write-downs due to past acquisitions that they overpaid for and now have to account for at the current value, which is less. Now, over the last 3 years, the company has seen net interest expense of $8.2 billion, and this should hopefully turn around as they do better with cash invested. Now, while net income has seen a 3-year decline of almost 55% since 2020, it has seen a 2-year increase of 33%. We're going to see this next in the cash flow statement. So what's the takeaway? While Alibaba hit a rough patch after 2020, things have been improving substantially over the last 2 years, and the trends are looking positive. Let's hop in the model. All right, income statement. As I mentioned, a lot to unpack here. We see a 5-year revenue growth of 2.3x. The company has consistently grown the top line. The bigger challenge has been cost control and impairments. So they've done a very good job keeping a lid on the SG&A costs and actually reducing the product development costs, which has resulted in a nice increase in EBITDA. We also mentioned the impairments that they've had right here. That's an unfortunate $5.8 billion that they've had. They've also had net interest expense of $8.2 billion over the last 3 years, which has ultimately resulted in a massive decline in net income from 2020 to 2021. But we see a nice increase over the subsequent couple of years. So we have a 3-year decline of 55%, a 2-year growth of 33%. All right, next we have the cash flow statement. While free cash flow took a big hit in 2021, it has increased 48% in the last 2 years. Operating cash flow has been flat the last 5 years, which is actually impressive considering the drop off in net income. The company has invested about $33 billion of cash over the last 5 years, very similar to the Mag 7, and generated more than $13 billion of income from this deployment of capital. We mentioned earlier the low leverage and financing the business with retained earnings, and this can be seen with only $3.4 billion of debt being issued over the last 5 years. With the stock down since the all-time high of $310 per share achieved in October of 2020, the company has wisely repurchased $33 billion of stock over the last 4 years. In 2023, Alibaba also returned $2.5 billion to shareholders via dividends, which is a positive to shareholders and shows that the company has confidence in its ability to pay those dividends moving forward. So what's the takeaway? The company's heading in the right direction, financing the business conservatively, returning billions of cash to shareholders, and cash is projected to 2.5x by the end of the model. Let's hop in the model. All right, cash flow statement. As we mentioned, a decrease in net income over the last 4 years, but a nice increase over the last 2 years. Operating cash flow has remained pretty steady. We talked about the purchases of short-term investments. Basically, they're investing their cash and it's returning them a decent amount, $13 billion over the last 5 years. We see a net issuance of debt of only $3.4 billion, which is fantastic. Also, since the stock has gotten hammered, the company's done a great job of repurchasing shares at these lower prices, and they issued a dividend starting in 2023 to the tune of $2.5 billion. Last but certainly not least, can't fail to mention, closing cash is projected to increase 2.5 times by the end of our model. All right, forecast drivers and DCF assumptions. Despite a reduction in revenue in 2022 and a steep decline from pre-COVID, Alibaba has managed cost effectively with operating costs flat as a percentage of revenues. $12.4 billion of debt has been repaid over the last 5 years, with another $4.8 billion over the next 5 years. The company has a very low beta of only 0.5, which has resulted in a very low weighted average cost of capital of only 5.6%. The company has low leverage, only 10% of total capital, and an A+ credit rating. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. All right, so looking at the DCF drivers, we see that revenue used to be high double-digit percentages, took a major drop off in 2022. That's when the stock got hammered, and it's recovered since. But the real key takeaway is right here. If you look at cost of goods sold, SG&A, and product development costs, they've actually remained flat over the last 4 years. This is a tremendous development when you see that the company's gone from the super high revenue growth to declining and then recovering, that they've been able to be so conservative in managing their costs. This is a tremendous positive. conservative. All right, DCF assumptions. So we see that they have a very low beta. The stock has basically gone sideways over the last 3 years. They have an A+ credit rating, low leverage, only 10% of total capital, significant amount of cash, $55 billion. But here's the other thing that I want to touch upon right here. So if we look, the company, I've put in a 7.5 times TEV to EBITDA for the terminal multiple. Now, this is actually very, very low. When you look at the comps, they're at 9.3 times. When you look at the current EBITDA multiple, it's 9.1 times. I looked at the last 12 quarters and the last 8 quarters, and I got 8.8x to 7.7x. So 7.5 is actually below the average of the last 8 quarters and is a very, very conservative number. All right, DCF valuation. We ran 3 scenarios, bear, base, and bull with the current model at base. Future cash flows are discounted back to today to get to TEV. We strip out net debt to get to equity value. The stock is up 23% over the last year and 38% year to date. They have been on the right trajectory since 2021. They have lots of cash, big investments, and a push into AI, but they're heavily exposed to a shaky Chinese economy. So is it worth buying today? Wall Street has Alibaba at an average of $106 per share, which is only a 4% discount. So what does our analysis show? Let's hop in the model. All right, y'all, DCF time. Woo woo. So we got EBITDA less DNA gets us to EBIT, less cash taxes gets us to EBIT or NOPAT. We add back the DNA. We take into account changes in operating working capital. We have CapEx as well as new intangibles. We have free cash flow to the firm. We then have our terminal value, remember 7.5 times terminal EBITDA. We take into account all of those cash flows to discount. We discount them by the discount factor. We get the present value of cash flows. We add those together to get total enterprise value. We strip out the debt. We add the cash. We strip out non-controlling interest. We add associate investments. We get an intrinsic equity value of $327.4 billion. We divide it by the shares outstanding. We get an implied share price of about $134 a share compared to the current price of about $102. That's a 31% discount, which is definitely a buy. All right, next, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and WACC versus the terminal multiple. 0 out of 50 or 0% showed a sell rating, 6 out of 50 or 12% showed a hold rating, 44 out of 50 or 88% showed a buy rating. We ran each of the 3 scenarios equally weighted. We got a weighted average value of $134, which is a 32% discount. So what's the takeaway? Utilizing conservative assumptions, we show a buy rating for the stock at a significant discount. Let's hop in the model. All right, so as we mentioned, vast majority show a buy rating. We have green everywhere across the board. Even if we have super conservative assumptions, a decrease in revenue growth to 4% and an increase in CapEx intensity, we still show a significant discount. Also, when we look at the terminal multiple, if 7.5 is conservative, think if you go down to 5.5, which would actually be crazy, it still shows a very conservative rating at a discount. Okay, last but not least, scenario analysis. We ran 3 different scenarios, bear, base, and bull. And even in the bear case, we get about $120 per share, which is a 17% discount. That's a hold rating, but it's very, very close to being a buy. We get a buy in the base case, a buy in the bull case for a weighted average of about $134, which is about a 32% discount to the current price and a definite buy rating. All right, the wrap up. So Wall Street has Alibaba at a high of $132, which is a 30% discount, an average of $106, which is a 4% discount, and a low of $76, which is a 25% premium. Our analysis showed a range of 120 or 17% discount in the bear case, 134 or 32% discount in the base case, and 149 or a 46% discount in the bull case. Now, you should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice. That being said, I do not currently have a position in Alibaba, but it is at a significant discount based on this analysis, which utilizes very conservative assumptions. Personally, my biggest concern is not with the company, not with the management, not with the operations, but with the company's heavy exposure to the Chinese economy. It's about 70 to 75% of their revenues. So what are some of those concerns? Slowing economic growth. China's GDP growth has been slowing with weaker consumer spending, which directly impacts Alibaba's core e-commerce business. Property market crisis. So there have been ongoing issues in China's real estate market, such as the debt crisis with major developers like Evergrande, and that's dampened consumer confidence, affecting retail sales. Weak consumer demand. So China's uneven economic recovery has seen slower than expected rebounds in consumer demand, which could weigh on Alibaba's e-commerce sales. Government stimulus. So recent government moves include cutting interest rates and rolling out stimulus packages, which are aimed at stabilizing the economy. This may actually help boost consumer spending over time. And then last but not least, the regulatory environment. Continued regulatory oversight, especially concerning data privacy, anti-monopoly practices, and tech dominance, creates uncertainty for Alibaba and other Chinese tech giants. If you like this and you want to see another stock valuation, check out my super microcomputer video here or my Amazon video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.